Okay, welcome to the next video on gaps. So what we're going to do here is look at some intraday charts. Most of the charts I've been showing you have been on daily charts, which is what I primarily use for my swing trading, and that's mostly because I day trade, so I don't want to be watching my day trades and my swing trades at the same time. So by using a daily chart, I don't have to look at my swing trades other than before the market opens and after the market closes, and I can just concentrate on my day trading. But also it's great because for those people who can't look at the markets during the day, which is a lot of people, let's face it. A lot of people have jobs during the day, imagine that, and so they still want to trade the markets, but they can't be looking at charts and having to make trading decisions during business hours. So daily charts are really the best way for them to go because they don't have to really make any considerations. They can put in their buy stops, their sell stops, their limit orders, all that stuff after the market closes, and it works out great. But on the other hand, there are some people who like to swing trade with longer term intraday charts. So showed some of that on the last video, and I'm going to show some more of it on this video, and we'll do a little bit of that as well. So people who trade both ways can see some examples. However, let's talk about these longer term intraday charts right now, and a couple of considerations, and then we'll get into the gaps. So as mentioned early on, I don't use the volume histogram on my day trading, and the reason for that is that it just forms a saucer pattern. Well, even on these longer term intraday charts, this is an S&P E-mini chart, 30-minute chart, and even here, even though it's a longer term chart, you can still see, you know, that's still what you're going to get every single day is this saucer pattern, day after day after day. I mean, that's it. So how is that really helping you? It's really not helping you too much, because that's just the pattern you're going to get. So it's not really all that beneficial. So you can put OBV, unbalanced volume, on here, and yeah, that might help you a little bit more, but even there it is influenced by these cup or these saucer type patterns. Now the OBV is not going to produce these kind of saucer patterns. Whoops. So it will form little different patterns for you, which can be more helpful than just the pure volume histograms, but it's still influenced by the fact that you're getting more volume at the beginning of the day. Why is this not writing? There we go. At the beginning of the day, at the end of the day, and the middle of the day is low volume. So that is still influencing OBV, and therefore, again, it's not going to be providing you as accurate symbols or signals as it would on a daily, weekly, and monthly chart. Okay, so just wanted to point that out, just to be very, very clear on that. Okay, but gaps on these longer-term intraday charts, these are really good and something that you should be aware of. So for example, here we're above the 50 MA. Okay, gosh, there we go. We're above the 50 MA, and now we gap down. So there's your breakaway gap, and something here to be aware of. Quite often when you get strong support levels or resistance, so here for example we've got the 50 MA, we've got the 100 MA, and we have this low. Draw that low in there. So this is a triple cluster of support. That's a lot of support. And so the market looks at that and says, you know, it's going to be hard to get prices to just plow through that. So what we'll do is we'll just open down here. And then we don't have to mess with that resistance or that support in this case. So that is one of the reasons that you get gaps, is that the people, the market makers, the specialists, etc., they're the ones whose job really it is to make a fair market. And you know, they just sometimes say, we don't want to deal with this, and so let's get through there without having to deal with the hassle of support. And some of the powers that be, whether they be big traders or whoever they happen to be, say, we're just gonna start the market down here. Now we don't have to deal with that. So that's a breakaway gap. Now we get a nice little spike here of volume on a candlestick reversal bar, and again that does mark the cycle low. We go back up, we get our retrace in a trend. That's actually a pretty nice little trade right there. We come back down, make a lower low. Now we come up pretty hard. Look at this, boom. The volume starts coming up a little earlier this day than usual. And this comes up very hard, but then the next day we boom, just gap right down. And again, it's just, you know, normally, by the way, of course, a lot of these gaps are caused on some type of news or rumors. So this really is another big gap. Now notice, when you get gaps, quite often you will get some pretty big volume bars. And so it makes it's a little bit of a lower low, I guess. We do not consider that another wave low. That doesn't happen until over here. The market actually ends up consolidating for the rest of the day. This whole day really ends up being consolidation. And the next day it consolidates too, but then you get this cycle high, and boom, then we put in our new low. Then look, market gaps up the next day. Comes back down, closes this gap, and I want to show you what happens from here. Away we go. So what I want to point out here is a couple of things. Breakaway gaps are usually fairly reliable to give you a good indication of the direction of the market for the next little while. It's a little longer term. I don't consider a breakaway gap just worth a half cycle. It quite often will start a new trend. And so when I see breakaway gaps like this, I'm thinking, okay, we could be starting a new 5-wave pattern. So a breakaway gap I consider a longer term indicator, and it's not like our volume is just worth basically a cycle, a half cycle. Breakaway gaps, no. We're considering that a breakaway gap may very well be starting a new long-term signal for a 5-wave pattern. Okay, so we love breakaway gaps. We watch for those for that very reason. Then the question, of course, is where do you get in on them? And you don't, you know, I'm not going to buy, or in this case short. I'm not going to short right here just because we get a gap. I'm going to wait for a retrace. I'm going to wait for a regular signal to get in. The breakaway gaps are the ones that are least likely to fill. You know, everybody, the common wisdom, the thing that every amateur believes about gaps is that you trade the fill of the gap. Well, it depends. This is what's so important to understand where you are in the structure, where the gap occurs in the structure of the chart. If it occurs early in a brand new trend, yeah, it may fill, but it may not fill for what? 1, 2, 3, 4, 5 days. Took 5 days, took a week for this gap to finally fill. So, you know, if you're buying, just because you get this gap on an intraday basis, if you're buying that, you're going to be woefully disappointed. So, breakaway gaps, we're not looking for them to fill right away, maybe longer term, but I'm actually looking to normally trade them in the direction of the gap. Now, having said that, sometimes they will fill. It depends how big they are. The bigger they are, generally, there's actually a lot to this, but if it's a real little gap, sometimes they will come back and just fill and then start that new trend. So we watch for that. If they're really big, then I will often draw a Fibonacci level about 50% in between that gap and look for it to fill just halfway. Sometimes it will fill all the way too, but still my general bias is going to be in the direction of the gap on the breakaway gaps, just looking for an entry. Okay, looking for a retrace in this new long-term trend. Now again, we trade it bar by bar, cycle by cycle, knowing that this could change at any time. In this particular case, though, the breakaway gap occurs through this support, triple level of support. 50 MA is turning over. There is no reason to trade this gap fill. Because we're early in the trend, we are not looking for reversal trades. This trend never changes. All that happens is the 50 MA turns over and angles down, and there is no indication of a gap fill on this. So there's no reason to trade a gap fill. All we're doing is looking for shorts, 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 shorts. Okay? Now, so that's breakaway gaps. Now, measuring gaps are the tricky ones. Those are the ones where we're never really sure whether it's going to be another measuring gap or it's going to be an exhaustion gap that ends the trend. Those are the tricky ones. So again, the basic rule is look at the structure, and if it occurs within the first 5 waves, we're going to say that probably the probability is that it is it's just a measuring gap. But once we get into wave 5 and beyond, then we're going to be looking for exhaustion gaps. If we get a gap then we're saying, especially waves 7 and 9, oh, you know what? We got a gap here, we got high volume, we got maybe a reversal candlestick pattern, shooting star or a hammer. And so I'm guessing that this one has a higher probability now of being an exhaustion gap because we're late in the trend. And when the longer the trend goes on, the less it's your friend. So that's basically how we analyze this. So this one gaps down. Let's actually draw some real horizontal lines here. Oops. Get some accuracy going. Okay, so here you see it does try to fill this gap, but it doesn't. So if you were to draw a line 50% in there, you would be pretty good. It comes back down. Basically, just as we said, it consolidates for a day and a half, day and 3/4. Finally goes down. So this gap is still not filled. And finally we get into an extended trend and we gap up. Now isn't that interesting? This is a gap down. This is a gap down. This one is a gap up. Now, as we get late into the trend, These are the gaps that are most likely to fill. So the ones that are least likely to fill are the breakaway gaps early in the trend. The ones that are kind of 50-50 are the measuring gaps. The ones that are most likely to fill are the exhaustion gaps, because again, we're late in the trend, we're actually looking for a reversal. And so we are looking for this gap to fill. Now most exhaustion gaps will actually be something like this. Boom. You'll have your gap here, and then the market will come back up and reverse and fill this gap. This one is a little unusual in that it actually gaps up. But then it does come back down and just fills that gap and then takes off like a rocket to the moon. Okay, so this gap up shows a lot of buying energy. Again, you got a lot of volume here, but it's the morning. But anyway, a lot of buying energy, comes back down, fills the gap, and this is where you're saying, yeah, structurally late in the trend, fills the gap, off we go. And that could be a beautiful day's worth of trading right there. Okay, let's pull up another chart just to give a couple examples. Okay, here's our next chart. Still the S&P E-mini 30-minute chart. But this one's very instructional. Now what I'm trying to show you here is some things that maybe are not quite as obvious. This is intermediate trading now. So the breakaway gap, the exhaustion gap, you know, these things are all pretty standard. I mean, the information's available on the internet. What I'm trying to teach you now are some more nuances, things that don't, again, fit the textbook examples, to help you think in real life situations here. Because really the markets rarely work according to textbook stuff. So here we cross above the 50 MA. Okay, boom, we're making a nice strong move up. Hard retrace back down. Next day we gap up. Okay, what type of gap is this? This is a measuring gap. So I consider it a measuring gap because a breakaway gap would occur before the trend starts. This trend has already started. This is working on the first retrace on the trend here. It does not break up here above this high. But here's an example of where don't assume that you have to have a breakaway gap, a measuring gap, and an exhaustion gap in every trend. You don't. Some trends have no gaps. Some might have a measuring gap, but no breakaway gap. Some may not have any exhaustion gap. So they don't always travel together. Okay. Okay, but once we get into a trend, then I start calling these measuring gaps. So I get a little measuring gap, and then it does fill that gap. Again, these gaps, you know, they're more likely to fill than a breakaway gap is. And then we go up and up and up. Okay, another measuring gap. Goes up, makes up a new higher high. Boom, another cycle low. Now, again, we get the gap to the, well, the other one we were looking at a downtrend. This time we get a gap from the high down to the low. So this is a type of exhaustion gap, but this is a type of exhaustion gap that you don't see in the books. At least I don't see it. Normally in the books they have the kind of gap that I was describing before. An exhaustion gap would be like this, and then the market comes down, and that is an exhaustion gap still. But other times it will go up, 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 and then boom, and the gap occurs on the way down. I still consider that an exhaustion gap. Okay, so this fills. Boom, the low of that bar just barely touches there. So this gap fills, and again, that's a beautiful short and this thing actually does end up reversing quite dramatically. Okay, let's look at a couple of case studies now. So here is a 5-minute chart of the S&P. I know some of you also day trade, so we'll show a little bit of day trading here in the last couple minutes of this video, just so we cover that aspect as well. So the next day starts, and as the next day starts, here's where we closed the previous day, and here's our new bar. Now, this is the first 5-minute bar of the day. By the way, when I'm using any interval of minute charts, like this 5-minute chart, I do not use pre-market or post-market data, and that's so that I can see the gaps. That's specifically so I can see the gaps. When I use tick charts, I use 24/7 data. I don't trade gaps on tick charts at all. Okay, question. This is your quiz. Which way do we expect this market to move? Is it highly probable for this market to close this gap and continue down? Or do we expect this market to go up? That's your quiz, and I'll give you about 3 seconds to consider it. You would have, in real life, you'd have about 5 minutes to consider it, but we're not going to give you that much time since these are 5-minute bars. But if you want to take 5 minutes, feel free, pause the video, but we're going to keep rolling here. Okay, let me give you the answer. The answer is, it depends. And I've already given you the answer in this video. What does it depend on? What it depends on is the big picture structure. We've got to look at the structure of where that gap occurs in order to know what we would expect. So obviously you can see now what happens is the market goes up. But why would we expect that maybe it would go up from there? Because this gap occurs after an extended trend. So this is a long trend. We had boom, gap up, big energy. It could still come back and fill. You know, sometimes it does do that. But whether it does that or not, we would be considering this most likely an exhaustion gap, and that the little longer term picture, whether short term it fills or not, would be it's going to go up. So we would be looking for longs this day primarily. Okay, let's look at one more example. Okay, here's another example on the 5-minute S&P. Okay, so the day opens, we get a gap down. Here's our first 5-minute bar of the day. Now, question is the same thing. What do we expect from here? Do we expect this market to go up or to go down? So feel free to pause the video, give yourself no more than 5 minutes, because that's all you'd have in the real trading world, and take a wild guess. Okay, now we're going to give you the answer. Market goes down, way downtown. Okay, and why would we expect that? Why is that the probability? Because it is a breakaway gap. 50 MA, all the moving averages are clustered together here. 50 MA is even angling up a little bit. We gap through all 4 moving averages. Again, the market decides it doesn't want to deal with that huge cluster of support, so it just goes down through here. That's a breakaway gap. Breakaway gaps are the least likely to fill, and they often will start a new long-term trend. Okay, let's give you one more example, and then we'll call it a day. Okay, this one may look similar to the last one, but it's actually a little different. So again, quiz time. This time we are not gapping through all the moving averages. The 50 MA is actually above price. So we're just gapping through the 100 and the 200. And here's where you open the next morning. What would you expect? Market go up, market go down. Are we going to fill this gap soon, or do we expect a prolonged downtrend from here? Okay, pause the video, give yourself 5 minutes if you need it, and answer the question. Okay, if you're ready, here it comes. Let's squeeze this video up a little bit, see what happens. Huh, look at that. Okay, let's draw our line on there for the gap close, which happens actually about right there. So now this is a very interesting one because this is a breakaway gap. It's the initial gap as the 50 MA is turning over, which normally we would expect would start a new downtrend. And yet what happens is it kind of tries, it fails, doesn't even put in one lower low, comes back up, and actually the market reverses and we go into a bit of an uptrend and we close this gap the same day. So how do we explain this? We explain it very simply. That is a breakaway gap. We would expect that the market will continue to the downside, but it's just a probability. And a lot of these probabilities, by the way, are not really huge probabilities. I would even say most of the probabilities that we trade in the market are slight probabilities. You have a slight edge. So therefore, again, back to our previous discussion in another video, do not get caught into the trap of thinking that these things are certain or even close to being certain. They're not. They're not even close to being certain. So just because you got a slight edge one way or another, realize that that edge is very slight and it can go away on a whisper. And so therefore, don't take any of this too seriously. And you always trade bar by bar, and you look for things to change. Always look for things to be changing. Trade bar by bar, cycle by cycle. And that's the only answer to this, because that is a breakaway gap. It's a big gap, and normally we would expect that that might be starting a new trend down, and it did not. Okay, so again, that's what's important about trading, is understanding that none of this stuff's to be taken too seriously. None of it's really all that reliable. It's about money management, it's about discipline, and it's about being flexible. You know, I'll just close with this. Darwin's theory of evolution, whatever you think of evolution, most people think it was about survival of the fittest. That is not what he taught. What he taught, which was so revolutionary, was survival of the adaptable. He said that the biological systems that could adapt to changing environments were the ones that survived the longest. And that is very, very applicable to trading. In trading, if you get too entrenched in any idea, any concept, or any thought of what the market should be doing, you're dead in the water. The traders who are successful are the ones who are continually flexible and continually adapting to market conditions. It doesn't mean you're changing your rules. That's not what I mean by that. It just means you're watching the market. Your expectations of what the market is going to do are fluid. You stick to your rules, but your expectations are very fluid. And you continually watch for any change of energy that will demonstrate that things are changing from what they were when you first looked at the market, 5 minutes ago, a half hour ago, an hour ago, whatever. Okay, that's it for this video.